All right. Hello, everybody. Thank you again for tuning in. Today, I have the great pleasure of speaking to Marc Dupuis. So, Marc, I'm going to let you introduce yourself, and then we're going to get into the whole talk about syndication and what makes syndication work and your past experiences with it. So, can you introduce yourself for us?
All right. And before I forget, I am not a financial advisor. I'm not a lawyer. And I'm not an accountant. So all of the information that I'm presenting is really just my ideas, my advice, my opinion. So before you implement any of it, get somebody else's opinion on this. Show them my video and see what they say. Okay. So just a little disclaimer there. So.
Sure. My name is Marc Dupuis. I live in Ottawa, Ontario, and we syndicate real estate deals both here in Canada and in the US. So we look for Class C apartment complexes that we syndicate with our investor partners.
Okay, fantastic. So now just for, I guess, newbie investors looking at this video, can you give me a brief description of what syndication is and what Class C means?
Gotcha. Yeah, that's a good question, actually, because so syndication just means pooling investors. And the Ontario Securities Commission or the Securities and Exchange Commission in the US, they see that as you have 3 people or more in a deal, and those people that bring money to the deal but don't have any control over the deal, so basically just silent partners, that's considered syndication. So if you have money in the deal but you're not making day-to-day decisions, you're in a syndicated deal. You can get around that if you are an actual owner of property. So if you and I decide to do a deal together and we're 50-50, or if there's 3 people or more and we're each 25% ownership, basically we each own our equal share, we basically have to all agree on what we're going to do, then that's not a syndication. But if you're creating a new company and you're selling those shares of that company to investors, that's a syndication.
Okay.
The Class C, so your Class A properties are those properties in town that have pools and amenities and brand new, sort of cream of the crop. Your Class B properties will be those properties in 10 to 15 years, and then your Class C properties have even less amenities and are a little bit older, have more of deferred maintenance, and that's where you get more. You're going to get more return. You're going to pay a lot less for those properties, and your upside is going to be a lot better. And that's why we get into the Class C properties. And those are typically the properties that have your typical blue collar worker that's nose to the grindstone, goes to work every day, pays his rent, and makes us really happy as landlords.
Right. And those are normally the people that we're renting to because they're the ones who need to rent. Right, as opposed to somebody who's buying their own house. So just a clarification.
And many of them never think they can own, so they're like tenants for life.
Yes, yeah, absolutely. So just to get a clarification, so what's the difference between syndication and a JV or joint venture?
It's all how you structure it. So you could have the same deal with the same people, with the same money and everything in place, but when you think about, a lot of people come to me and say, well, I just bought real estate. Like I partnered with these people who just bought real estate. So I said, okay, what did you buy? What did you end up buying? That day that the transaction happened, what did you buy? Well, I own a piece of property with these 4 people.
Okay.
If that's the case, then that's not a syndication. But if what the syndicator is doing creates a corporation and sells you a share, now you don't own real estate. You own a share in a company. That company owns real estate, but you don't own the real estate. So if I was to do a title search on that property, I wouldn't see your name. I would see ABC Corp.
Gotcha. Okay, good. I'm so glad that you clarified that because even though I've been in real estate for 20 years, that's that's still new information, right? So that's fantastic. Okay, so now I want to learn more about the whole syndication world. So how did you get into syndication, and what are some of the things that we would benefit from doing a syndicate?
Yeah. So initially we were doing deals here in Ottawa. Okay. So I basically really cut my teeth on doing deals at nobody else really wanted to do.
Okay.
Things that realtors couldn't sell, I would pick them up, fix them up. Some of them I demolished and rebuilt.
Okay.
And then when we got to the point where Ottawa kind of got really tight, and we couldn't do the same kind of returns, that's when we started saying, and we started getting bigger. We're like, okay, it's time to scale, and where do we get these kind of returns still? So it's a matter of, real estate is a cycle, right? Up and down and back up and down, right? So we started kind of really thinking about this from a business perspective and sort of saying, okay, how do you make money in real estate, right? Everybody knows, buy low, sell high. So at the time, Ottawa was high. I'm not, okay, can't buy in Ottawa because the formula isn't buy high, try to sell higher, right? It's buy low, sell high. So where is it lower? And that's when we started to look at, okay, where are the different markets, and what makes a market kind of poised to be at that point where it starts down here and it's on the climb.
Yeah. Mm-hmm.
So a lot of people come to us looking from that perspective, saying, I don't know, like, I understand what you're saying, but where do you go? Where do you find these? Is this market good? Is that market good? Is it too late? Is it too early? So we do a lot of research to make sure that that market that we're getting into is the right market.
Mm-hmm.
And there's a bunch of indicators that we look for to see, to make sure that the market is right. And then we get in. Once you get in, it's the market sort of takes care of itself. A lot of people say, wow, Mark, like, how did you know? You're so smart. I'm like, it's got nothing to do with smart. It's just the market just went up. All the rents were going up, rents were going up, rents were going up. At the same time, cap rates get compressed, and that's how you get your value. So we just find those right markets that are at that point and just get in and just wait and let the market take care of itself.
Right. So how long ago was the situation that you're talking about where you guys, where you were in Ottawa and then you started doing this transition?
That was 2012.
2012. Okay. So quite some time ago. And it was during the last cycle down, right? So do you only do syndications now?
No.
Okay. So you do a bunch of other strategies too. Okay.
Yeah.
So with just focusing on the syndication, what are some of the returns that somebody could expect?
It's a very tricky question.
Okay.
Only because it's against the law for me to quote returns to people.
Oh, okay.
Right? Because this is how the Securities and Exchange Commission basically look at it. Let's say, Huong, you came to me and you said, hey, I want to get in one of your deals.
Okay.
And I said, perfect. The minimum buy-in's $50,000. You're like, great. Here's my $50,000. And I'm like, great. I put it in a deal. Well, I don't know that you went home, you sold your car, sold your house. That's all the money you had. You're now living in a cardboard box, and that's it. You're thinking, my God, I hope Mark's deal works out because that's my, it's my silver bullet, right?
Okay.
Deal goes sour. I get in front of a judge because you go, oh my God, you took all my money, right? We get in front of a judge. The judge says, what were you thinking? Why did you take all of her money? She didn't have the capabilities of, she doesn't have any more income, she doesn't have any more money, right? So they try to protect the investor. So I can't quote actual returns, and I'm just kind of prefacing what I'm going to tell you now by saying I'm not quoting an actual deal here. I'm not pitching an actual deal to anybody.
Okay.
So I'm going to tell you what we look for as a business model. This is kind of what we look for.
Okay.
And people who are interested in get connected with us, we'll pre-qualify them, and we'll make sure that we're okay to talk to them and kind of discuss an actual deal with actual numbers.
Okay.
So what we look for when we get into a market is we look for, ideally, I'd like to get something that's an 8 cap. Nowadays, the market's so tight that we're leaning more towards 7 caps.
Okay.
But the 7 cap, if we can get a 7 cap, once we put some leverage on there, right, with some institutional financing, that will get us to about 11, 12% on a cash-on-cash return basis for the project. And so what we do is we will give the investor 75% of that. So 75%. So let's suppose I was able to find an 8 cap. I find an 8 cap, it generates 12% cash-on-cash return for the year. We give 75% of that away to the investor. So that's about 9% cash-on-cash on year one. Now, don't forget that we buy these complexes knowing that they're down here because of some reason. Bad management, there's some units are down, or they need some renovations, or what have you. But there's some upside. Sometimes it's just the owners are just a mom and pop kind of operator, and they just don't know the market's taking off. So the rents are really low. So it's a combination of, let's get those rents up, let's get those expenses down to a market expenses, and let's keep generating some cash. And let's, like I say, if there's some of these units that are down, let's get them fixed, and let's get them up and running and cash flowing. So as we kind of move forward, it takes us a year or 2 years to get all those things changed.
Okay.
But that's going to get us to the point where we're cash flowing a lot better. We've got our expense. We usually get a property manager in the market that's really knows the market. Like our guy in Louisville, Kentucky has 6,000 units in the market. So he knows exactly what's going on in the market as far as rents and expenses. So we turn it over to them. They manage it for us.
Gotcha.
Normally we look at a 3, 5 to 7, kind of a hold period. It all depends on what kind of financing we can get, where we are in the cycle. Once we get to the end of that cycle, we like to have the returns. We like to have our investors get a high teen, low 20s return.
Right. Okay. Just a couple of points then about the stuff that you said there. So this isn't like a quick turnaround thing, like 6 months, a year. Like it's somebody who needs to be in it long term with you guys, right?
Yes.
Like maybe 2 years minimum. The longer the better, basically, right?
Well, it's a good thing that it's interesting that you bring up that point, because what we like to do is we buy the property. It's been, let's say there's some deferred maintenance, and it's in a market that's appreciating.
Okay.
So rents are starting to go up. So we get in, we do all the fixes that we need to fix, whether it's get rid of the management, put in our own management, fix all the units that need to be fixed. And sometimes it's not a matter of fixing them, it's a matter of upgrading them, because we see the properties next door are all getting an extra $200 of rent because they have upgraded bathrooms and kitchens. So if it makes sense, we'll do that too, to go get that extra $200 of rent. So the reason we do that is because we're hoping that in the 12 months, 18 months that we do that, we're able to increase the value enough that we can refinance the property. And at that point, if we get the refinance enough, we can get investors their money back. Now, we still own the property. We just refinanced, got some new debt on the property.
Yes.
Investors get their money back, and we just keep rolling.
Okay. So fantastic. So now you mentioned a couple of terms that are very well known within the industry, the cash on cash and the cap rate. So for somebody who's new that's watching, they're not going to know what that is. So if you are new and if you're watching this and you don't know what cap rate is and you don't know what cash on cash, just Google it. There's so much information out there. Okay. So fantastic. So now you mentioned about the pre-qualifying to get into it. Can you tell me a bit more about how that process works?
Okay. So in the eyes of the securities regulators, there are different types of investors.
Okay.
And they have a term called accredited investor.
Okay.
An accredited investor is somebody that has $1 million net worth,
Yes.
or they have income of $200,000 or more, or combined with their spouse, they have an income of $300,000 or more.
Okay.
If I came across a bunch of accredited investors today, I could do a deal with them right away, because they're accredited. In the eyes of the regulators, they say, okay, you've obviously done this enough. You know what you're doing. We don't need to worry about you. Go ahead and do some deals.
Okay.
If people are not accredited, then I just need to do more due diligence on my end. We can still put some non-accredited investors in some deals. It's just I need to do some more work to make sure, like I was saying a while ago, I don't take your last 50,000. I make sure you understand what it is that we're doing. This is a real estate deal. This is kind of what makes it go up. This is what could happen. These are the things so we create, when you're dealing with a non-accredited person, you basically have to do a disclosure of, this is who we are as a company. This is the deal that we're doing. Here are all the numbers. And it's all like we have our securities lawyer produces that document.
Okay.
And for accredited investors, we don't even need to do it. We can just do a verbal. Now, we never do that because we want to make sure people know what they're getting into. But when you're dealing with non-accredited investors, you have to do a disclosure.
Gotcha.
So we do those disclosures. It's all legal documents that the securities guys produce, and just to make sure that everybody knows what's going on. And I make sure that, like, I meet everybody that we deal with to make sure that they understand this is what's going on. We're buying real estate with this money. Yes, okay.
Right.
It can fluctuate because we get more tenants tomorrow, less the next day, or
Right.
just to make sure they understand. The last thing I want to have happen is somebody come to me and say, "Well, I didn't know. I didn't know that."
Yeah, because regardless of what strategy you're using within real estate, it still has that same level of risk, right? Because
Yep.
it's all affected by the same factors. So that's great. So I wanted to tap into your past experience and find out, like, what makes you guys stand out from other companies that do this, right? And so, like, you have some tips or some stories to share?
That's a really good question. When you look at why people invest in real estate, you can invest in all kinds of other things, right?
Yes.
But why do people invest in real estate? Because it's got better tax advantages, right? But you can only get that tax advantage if you're an owner. So I see a lot of people doing second mortgages, and I'll JV with you. I'll just be the lender, right?
Yeah.
They don't get the advantages that being an owner does.
Okay.
So when we do deals, we give them ownership. They get, like, if we create an LLC that's going to own this property, they own 75% of the LLC.
Okay.
So what does that mean? That means if we buy the property for $1 million, and yeah, there's cash flow every month, and they're getting, let's just suppose they're getting their 10% or their 9% every, year on the cash flow. That's great. But now, based on all the work that we've done, and we've replaced the management, and we've made it, shiny and new, and it's in the market that's appreciating, now that property is worth $2 million. On a straight, in a traditional JV relationship, or if you're just a mortgager, you just lent money to that person to do that, you just got your mortgage payments, right? But our partners basically own 75% of that new $1 million that we created, right? So they've now not just got their 10% return, but they've also got another 700. If they were let's say there was just one partner with us, they got 750,000 of that $1 million as part of their return as well.
Okay.
So that's what we really preach with people is, get in on the ownership side. Don't just be an owner. Get in on the ownership side. And with the syndication model, because a lot of people say, well, I don't know anything about owning real estate. I don't want to deal with tenants. I don't want to deal with fixing this or fixing that. That's the beauty of syndication. Somebody else is doing that work. You own 75% of the deal, but they are doing the work. That's the end that we get. We get that 25% because we're managing that. You're not going to get a phone call in the middle of the night saying, I lost my keys, or my toilet won't flush, or somebody broke my window, or I'm leaving, or we need a new tenant. Then nobody deals with that, right? We take care of that. Actually, the property manager takes care of that. So that all they do is they take the returns. That's it. That's all their responsibility is for.
Okay. All right. So how did you guys structure your company to make it better than another company that's offering the same type of strategy for investors?
Part of it is, like I said, is that what we just talked about that having a piece of the LLC that owns the property.
Okay.
Right, where other people just say, hey, Huong, how about you just lend me that money? I'll take the money. I'll give you a mortgage. I'll take that money. I'll buy it for $1 million, and I'll turn it into $2 million, and I'll keep that extra $1 million for myself. We structure it so that the company that's going to own the property is owned 75% by the investor.
Okay.
So in that sense, we're structured differently. There's also some different things that we do just on how we, because we're really focused on bringing value, right? Not just, let's get into a deal, right? A lot of people come to us, let's just do a deal. I want to do another deal. I'm like, yeah, I want to do another deal too, but it's not, well, what about this one? I'm like, no, that one's not going to do the trick for us, right? It'll get us into another deal, but the numbers aren't there. we're not going to be happy. You're not going to be happy. If I do this deal, you're going to, coming back to me and saying, hey, why are we not getting the returns like the first deal, right? So we do a lot of research, first on market and then on the property. So that's a lot. I mean, that's things that we push to people when they first start getting involved with us.
Okay.
Why are you in Charlotte, North Carolina? Why are you in Louisville, Kentucky? I send them a report. It's the same thing with here in Ottawa. Because we live here in Ottawa, we have a meetup here in Ottawa. A lot of the people at our meetup are investing in Ottawa. And I asked them, why are you investing in Ottawa? Well, I thought Ottawa was a good market. I'm like, yeah, it is. Why is it a good market? And they don't know. They're just like, I don't know, it just is, right? So we do that research, and I point out to them, this is why. This is why. So when this changes, things are going to change. So we're on top of it, so we know, okay, it's time to get out. It's time to start buying, or it's time to do a different strategy because some of the things in the marketplace have changed.
Right. So if somebody's looking to put in money this way and use this as a strategy in their real estate portfolio, is there one or two tips that you would say, okay, if you're going to do this strategy, this is what you need to check for before you give your money over?
The biggest thing I would say, because syndicators, anybody doing deals, they're just people, right? Mm-hmm. So you want to make sure when you're doing a deal, like I always tell people, and I always try to trick people. I always say, if you want to do a deal with us, yeah, sure, okay, give me some money. And they'll pull out their checkbook, and I'm like, what are you doing? Well, you told me to give you some money. I'm like, what did I tell you before? Never, ever, ever give me money. Never, ever, ever give me money. Okay. Right? You send that money to the lawyer who's closing the transaction, because in that case, that's the whole Bernie Madoff story, right? Bernie Madoff was like, give me the money. This is what I'm going to do with it. Mm. But he didn't. He started buying boats and planes and whatever else he was buying, right? So if you want to make sure that you're dealing with, or make sure that there are no outside influences, or your money doesn't go to somewhere you're not thinking it's going, send it to the attorney. Okay. That attorney has a trust account, right? And people just go, well, we might write, Royal LePage and trust. Big deal. What does it really mean, right? Well, trust accounts are highly scrutinized and insured. So the lawyer can only do certain things with that money. It comes in for this deal. He can do two things for that. Put it in the deal that it's supposed to, or if that doesn't work out, it goes back to you. It doesn't come to me. It goes back to you. So very strict rules, and that's how we do business. We deal with the securities attorneys and all the closing attorneys. It's not just give me a check or give me a box full of cash or none of that. It's all legitimate. It's all put in place to make sure that your money is protected.
Okay. Yeah. Okay. That's a great tip, especially to ensure that your funds are going to be secure from day one, right? Yeah. Okay, that's fantastic. Have you had some lessons learned already in your career that you can share with us that would be like, okay, this is something I've already learned, and so I'm passing it to you so you don't have to go through my growing pains?
Yeah, I've grown a lot. I've had a lot of pains from growing. When I was first building our portfolio here in Canada, it was mostly single family, some small multifamily, some condos, and then we got into building, and I built some brand new homes. I built some pretty exotic homes actually here downtown Ottawa. But then we decided to take that portfolio and liquidate it and bring those funds to the US. And we got involved with a syndication company out of Ottawa that was doing deals in the US. And that deal ended up being a complete loss. The syndicator was, even though he was saying the right things, he wasn't doing the things that he was saying. So, research your market. Okay, great. And at this point, we were still kind of figuring out what are all the right things to do. Like, what makes a good market? Is it just because there's a city? Is that a great market? So at that point, we were still kind of figuring it out. And he's like, look, I got it figured out. Get your money into my deal. We'll be all right. So we did. We put in some money. And like I said, it was a total loss. And then we realized that, basically step number one, like that right market, that market wasn't right. It was a one horse town, and once the one horse left, that was it. The time was done, and so was our investment. So we do a lot of making sure that those are the the market's right, the property's right, all those things kind of follow through, right? Even from the research on. I don't take spreadsheets for research. Like a realtor will give me a spreadsheet. Here are all the rents. Okay, great. That's a good start. But now let's do a lease audit. Let me see the deposits. Let me see the deposits that match that. If they don't match, we've got a problem. You just put some stuff on the spreadsheet, and that doesn't work for me and my investors. And it's fine. If you want to lie like that, I'm okay with that.
Doesn't happen. Come on.
I analyzed the deal for one of the members of our meetup here in Ottawa. So looking at a 16 unit in Castleman.
Okay.
And Mark, can you help me do the analysis? Sure. Send me the P&Ls, the profit and loss statement, and the rent rolls. So he sent me all that data, and I went through it line by line. It was only 16 units, so it wasn't a big deal. But the rents were going, they were showing rents on day one at, I don't know what the exact numbers were, but the rent was a certain amount, and day two, the rent was like 30% higher. I'm going, okay, but this, to me, it just seems something's fishy. And there was a bunch of them like that. And so I went back to him, I'm like, okay, to me, and I've never spoken to these guys, I don't know them from Adam. I'm like, to me, it looks like they're cooking the books, or they just had really low rents at one point, and somebody left, and they were just able to go up to market rents. I thought, that could happen, or one or two, maybe three of them in a 16 plex, but there was more of them. There was 4 or 5 of them, I think. And he ended up having a conversation with the sellers because there was no agent involved. He had a conversation with the sellers, and the sellers said, "Yeah, me and my partners are kind of cooking the books."
Just like that.
Just like that.
We were honest about saying, yeah, we're cooking the books.
So the books, to me, the numbers tell a story. And so I look and I see what the story tells me, and it's just like, okay, what are the numbers telling me? And if something doesn't make sense, I ask the question, why is this like this? Why did the rent jump 30%? It could be that it makes sense, maybe, but if it doesn't, and I want to, trust but verify. So that's and that's a big thing for people who get involved with us. They get all that research. Here's the research on the market that we've done. Here's the research on this property that we've done. Here's all that stuff. I've had guys come with me. We had an investor out of Vancouver. Him and his wife came to Charlotte. They spent 3 days with me in Charlotte, North Carolina. They were on site with me when we were doing some of the inspections were being done. They were kind of sort of out there, over there, kind of just watching us do what we were doing. They weren't. They said they wanted to be engaged, but they weren't really. But we've done that in the past. I don't know if I would do that a lot, but most people just trust that you're doing what you're supposed to be doing. You've got the documentation that backs everything up. There you go.
Okay. All right. That's fantastic. So, is there like a takeaway that you would want to partake to our viewers about the syndication strategy?
Syndication is really meant for those people who they know they need to invest in real estate because they understand the benefits, and they don't have the time. They don't have the time, and they don't. Even if they saw a deal, they don't even know. Is this a good deal? I don't know. So that's really syndication in a nutshell, and that's really the people that we cater to. If you don't, we have one of our investors is a brain surgeon out of Vancouver. He doesn't want to talk to me more than 10 seconds, right? He doesn't have the time.
Yeah.
So when you get on the phone call with him, it's like, yep, okay, good, no, yes, bang, good, gone, right? Okay. So that's kind of that's sort of who we target, those people who want that, they know they want the real estate, they know they want to be on the ownership side of the real estate, and they just need somebody to bring them deals and put the things together in the right markets. And that's exactly what we do.
Yeah. So what I'm hearing from you saying that is, even if you work full time, you're too busy and you know, and you don't know how to analyze properties, don't let that be a reason why you don't invest in real estate, right? There's
Exactly.
people like you who will do all of that work for you, so that you don't have to, right?
Yeah. And I wouldn't blindly just go, okay, I'm going to invest with, you know, I want to invest in real estate, I'm going to invest with a syndicator, I'll just let him or her do all that work. Great. I would still verify, you know,
Who they are.
still need to have an understanding of how real estate deals work and how things are put together. I had so we're starting to get a little bit more into assisted living, because I'm seeing that that's the next phase of the market. So Amanda and I were in Miami in November.
Okay.
Is it November? Yeah, I think it was November. As soon as I came home from Miami, I went to meet these guys in Detroit. They were operators of some some assisted living facilities.
Okay.
They wanted to start becoming syndicators. So they say there was two guys in this company. One guy was a lawyer, and the other guy was the guy who was the expert in the assisted living. And they just said, look, Mark, all we want from you is you to bring your investors for the equity piece, and we'll take care of the rest. I'm like, okay, no problem. The numbers work. I'm happy with that. So what do you need? Well, we just need this 20% or 15%. I can't remember I think it was 15%. We just need the 15% down payment. I said, okay, great. What about the rest? There is no rest. That's it. That's all there is. I'm like, no, there isn't. There's more to it than that. You're going to need all kinds of other things to make this deal happen that you're going to need cash for. Mm. And they had no clue. They're like, no, all we need is the down payment. I'm like, no, don't. You need more. So that's why I'm saying people that even if they're going to get involved with a syndicator, it's good to understand how a syndicator, even at a high level, how a syndicated deal gets done. What are all the pieces? Because you don't want to get involved in a deal that's just never going to happen. It's just a waste of your time and everybody's time, and hopefully it's your money. But so that's my advice: is get involved with somebody, learn enough about what they're saying to see that makes sense. What they're saying makes sense. I come across a lot of people all the time, and some people talk to me about stuff, and I'm going, what you just said makes absolutely no sense. I know you used a lot of buzzwords, but it didn't make any sense, because I know how the deals work, and I know how a real deal works. Mm-hmm. What you're pitching me is pie in the sky, and it just doesn't make any sense. And for that reason, I'm just not even interested in talking to you, because you obviously are trying to scam me, or you don't know what you're doing.
And it's just a waste of time anyways.
Exactly. And if you get involved with the wrong people, especially if you put money into the deal and it goes sour, now you've lost your money on top of wasting a bunch of time. Mm-hmm. Mm-hmm. So okay. They say you can never do a good deal with a bad person, right?
Never do a good deal with a bad person. Okay. That's a new one. I have not heard of that one.
Oh, you heard that?
No. So, all right, Mark, thank you so very much. I really appreciate you taking the time to share your information and your knowledge. It can be very, very complicated, and today you've shed some light and made it a little bit easier. So thank you so very much for doing that.
Pressure was on mine.
So I will include your contact information. So what's the best way for people to reach you?
Best way to reach us, or to even just to get some information about what is a syndicated deal, or how do these things work. Okay. You can go to www.simpleacquisitions.com, okay. And there's a bunch of campaigns on there that you can sign up. They're free, okay. And it's just they're short video series on how do we do analysis, how do we pick a market, how do we pick a building, those kind of things. I think there's one of them's, I know Amanda's done a couple of series on some of the securities. Okay. Pieces that, what are the documentations that's involved. Whether you deal with us or not, these are things that need to be in place to make sure that, you're dealing with somebody who's legitimate, you're dealing with somebody who's got all the right paperwork together and all that kind of stuff, to make sure that, your deal's going to be, successful. Because if something happens in the deal, the profits from the deal are going to pay for them to defend themselves. So that's going to dilute your profits, right? So there's campaigns on there that talk about those kind of things, so they can go there and get some information on stuff, and our contact information is on there too. There's a contact us page if they have any questions, or if they want to see deals that we're working on, then all the better.
so I will include your contact information then below in the blurb. Okay, and then I'm gonna let you do the last comment, the last goodbye to everybody. What is the last thing you would like everybody to partake with?
Well, it's going to be my tagline.
Okay, what is it?
Our tagline is smart
and simple.
Simple. Yeah, smart and simple.
Simple.
Yeah.
Yeah, I like that a lot better.
Yeah.
Yeah, smart and smart and simple. Because if it is smart and simple, most likely it will be secure.
Yeah.
Right. So.
Well,
okay.
yeah.
All right. All right. Super. So thank you everybody for watching.
Hi, I'm Huong with Cash Property Inc. We help you, regardless of age, financial situation, and education, get as much money as you want. If you like our video, please click on the like buttons below and subscribe to our channel.